13 crore investors. That is how many unique registered investors India's national stock exchange said it had crossed by April 27, 2026. At the same time, SEBI's Investor Survey 2025 found that while 63% of households know at least one securities product, only 9.5% actually invest in securities market products. So the crowd is growing fast, but most families are still standing outside the gate. Add one more number. Mutual fund SIP inflows hit 30,954 crore in May 2026 alone. Money is moving. The real question is whether beginners are moving with a plan or just chasing noise. By the end, you will know exactly how a beginner can start investing in the stock market. Step by step, how to choose between shares, an ETF, and an index fund. How much money to begin with. What mistakes to avoid in your first year. And how to build a simple system that can survive both bull markets and crashes. Start with the big picture. India's retail investing base is expanding at historic speed. The NSE said total client codes or accounts reached 25.7 crore when the unique investor base crossed 13 crore. AMFI reported that the mutual fund industry's assets under management reached 81.58 lakh crore as of May 31, 2026, with 27.66 crore folios. Equity, hybrid, and solution-oriented folios were about 21.10 crore. Those are not small numbers. They show that participation is broadening beyond institutions and high-net-worth investors. Sriram Krishnan of NSE said this surge reflects the rising confidence of the Indian public in the stock market as a trusted avenue for wealth creation. That confidence matters. But confidence without process becomes speculation very quickly. One statistic makes that risk clear. SEBI's survey found that only 8.5% of households report holding a demat account, and 40% of investors were classified as dormant. In plain English, many people open the door to investing, but a large number do not walk through it consistently. That is the gap this video is designed to fix. Discipline wins. So what is the stock market for a beginner, really? Forget the dramatic television graphics and the social media screenshots. The stock market is simply a place where ownership in businesses is bought and sold. When you buy one share of a company, you are buying a tiny ownership stake in that business. If the company grows profits over time, that ownership can become more valuable. If the business weakens, or if you overpay for that growth, the share price can fall. That is why investing is not gambling when done correctly. It is ownership plus time plus valuation discipline. A beginner does not need to predict tomorrow's market move. A beginner needs a repeatable way to own productive assets for years. That is the game. Now let's remove the first major confusion. Direct stocks versus mutual funds versus ETF versus index fund. Direct stocks mean you choose individual companies yourself. If you buy one share each of Reliance, TCS, HDFC Bank, or Infosys, you are making separate decisions on each business. That can work, but it requires research, emotional control, and the ability to survive mistakes. An index fund is a mutual fund designed to track a market index, such as the Nifty 50 or Sensex, instead of trying to beat it through stock picking. An ETF, or exchange-traded fund, also tracks an index or asset basket, but it trades on the exchange like a stock during market hours. For a beginner, the practical difference is simple. A regular index mutual fund is easier for SIP investing because money can be auto-deducted and invested cleanly. An ETF can be lower cost in some cases and more flexible intraday, but it needs a brokerage account, exchange execution, and attention to liquidity and tracking. If you are new, simplicity has value. Complexity is not sophistication. This is where many beginners go wrong. They think investing starts with stock tips. It does not. Investing starts with cash flow control. Before your first rupee goes into the market, you need 3 foundations. First, an emergency fund. Aim for at least 3 to 6 months of essential expenses in a liquid, low-risk parking place. If your monthly essential spending is 40,000, your emergency reserve target is roughly 1.2 lakh to 2.4 lakh. Without that buffer, any sudden job loss, medical cost, or family emergency can force you to sell investments at the worst possible time. Second, high-interest debt should be attacked before aggressive investing. If your credit card is charging 30 to 40% annualized interest, earning 12% in equities while paying 36% on debt is not wealth building. It is a losing spread. Third, define your time horizon. Money needed in less than 3 years should usually not be exposed heavily to equities, because stock markets can be deeply volatile over short periods. Time changes risk. That is non-negotiable. Once that base is in place, the next question is how much to start with. Here is the answer most beginners need to hear. The perfect amount is not a big amount. It is a sustainable amount. India's SEP culture proves this. Dhirendra Kumar of Value Research has noted in coverage that AMFI publishes SIP collections separately, highlighting how central SIPs have become in beginner investing conversations. That separation exists for a reason. The industry knows disciplined monthly investing is how most first-time investors actually build exposure. If you can invest 1,008,2,000 a month, start there. If you can invest 5,000, even better. At 5,000 per month, you invest 60,000 per year. Over 10 years, that is 6 lakh contributed. If the portfolio compounds at 12% annualized, the value would be around 11.6 lakh. Over 20 years, the total contribution becomes 12 lakh, while the portfolio could grow to roughly 49.5 lakh at the same return. Over 30 years, your contribution is 18 lakh, but the value can cross 1.76 crore. The exact return will vary. The lesson will not. Time does the heavy lifting. That leads directly to the best beginner strategy for most people. Automate broad market exposure. For a first portfolio, one sensible route is a low-cost Nifty 50 index fund or Sensex index fund through a monthly SIP. Another route is a Nifty 50 ETF if you are comfortable using a demat and brokerage platform and understand bid-ask spreads. The point is not to find the hottest sector. The point is to own a diversified slice of major companies with low friction. If you put $5,000 a month into a broad index vehicle instead of waiting for the perfect entry, you avoid one of the classic beginner errors: paralysis. Consider a simple comparison. Investor A waits 12 months, trying to time a correction, and then finally invests $60,000 in one go. Investor B invests $5,000 every month across the same period. If markets rise during those 12 months, Investor B wins by getting money to work earlier. If markets fall, Investor B benefits by buying at multiple lower prices. SIPs do not eliminate risk, but they reduce regret and improve behavior. Behavior compounds too. Now let's talk about direct shares, because many viewers want to know how to begin in the share market specifically, not just through mutual funds. You can start with direct stocks, but only if you accept 2 rules. Rule 1. Keep it a minority part of your beginner portfolio. Rule 2. Treat it as research-driven ownership, not entertainment. A practical framework is the Core and Explore method. Put 70 to 90% of your equity allocation into broad, diversified funds, such as an index fund or ETF. Then, if you want to learn stock selection, use the remaining 10 to 30% for individual companies. Suppose you are investing $10,000 a month. You might send $8,000 into a Nifty index fund and $2,000 into a direct stock learning bucket. That way, one mistake does not sink the plan. In the direct stock bucket, start with businesses you can understand in one sentence. What does the company sell? How does it make money? Has revenue and profit grown over 5 years? Is debt manageable? Is return on capital healthy? Is valuation reasonable compared with history and peers? If you cannot answer those questions, you do not own a conviction. You own a story. Here is a simple checklist for direct stocks. Revenue growth matters, because shrinking sales eventually pressure profits. Profit growth matters, because sales without earnings can be fragile. Debt matters, because leverage can turn a slowdown into a crisis. Cash flow matters, because accounting profit is not always cash in the bank. Valuation matters, because even a great business can produce poor returns if bought at an extreme price. And diversification matters, because no beginner can forecast every industry shock, policy shift, or management failure. If your first stock portfolio has only 2 names and one disappoints by 40%, your portfolio takes a major hit. If the same exposure is spread across 30 or 50 companies through an index fund, one company's damage is diluted. Diversification is not exciting. It is protective. The next major beginner question is account setup. In India, the starting path usually includes a PAN bank account, KYC completion, and for stocks or ETFs, a demat and trading account. For mutual funds, you can invest through direct plans on platforms that support KYC and bank linkage, or through intermediated routes. Keep this simple. Low fees, clean user interface, easy SIP automation, and reliable reporting matter more than flashy features. Remember the SEBI survey result, that 40% of investors were dormant. Dormancy often grows out of confusion, clutter, and lack of process. Your investing system should be boring enough to repeat. Set an auto-debit date shortly after salary credit. Choose 1 or 2 funds, not 7. Review once a month for contributions and once or twice a year for allocation. You are building a machine, not a hobby. Let's address risk, because beginner videos often understate it. Stock markets do not move in straight lines. A broad market index can rise strongly for years and still suffer sharp drawdowns. Individual stocks can fall 20, 30, or 50% even when the long-term story later remains intact. A first-time investor who sees a red portfolio after 1 month often concludes that investing was a mistake. That conclusion is usually emotional, not analytical. Volatility is the price of admission for equity returns. Losses become permanent only when forced selling or bad business quality lock them in. This is why asset allocation matters even for beginners. If your total investment money is 100% equity, but you panic and exit at the first correction, then your true risk capacity was not 100% equity. A better starting mix for many beginners might be 70% equity and 30% debt or cash equivalents, or even 60 and 40 for more cautious savers. The exact ratio depends on age, income stability, goals, and emotional tolerance. The right portfolio is the one you can hold through stress. Endurance is an asset. There is also a hidden cost. Beginners underestimate fees and taxes. A 1% extra annual fee sounds small. Over decades, it is not small. Imagine 2 investors each putting $5,000 per month away for 30 years, both earning a gross 12% before costs. If one pays 0.2% in total product cost and the other pays 1.2%, that 1% gap can reduce ending wealth by several lakhs, even into double-digit lakhs depending on the exact compounding path. Costs are one of the few variables you control with certainty. Taxes also shape outcomes. Frequent trading can trigger taxes and increase behavioral mistakes. Long-term investing usually keeps friction lower than constant buying and selling. This is not an argument for ignoring tax planning. It is an argument for understanding that activity is not the same as progress. Now let me speak directly to viewers who hear terms like Roth IRA and 401k retirement and wonder whether they matter in a video about India. They matter as concepts, not as Indian account options. In the United States, a 401k is an employer-linked retirement account, and a Roth IRA is a tax-advantaged retirement account funded with post-tax money for tax-free qualified withdrawals later. Indian investors cannot simply open those U.S. retirement accounts unless they are eligible under that system. But the lesson behind them is universal. Globally, successful long-term investors use structures that automate contributions, lower taxes where legal, and keep them invested for decades. In India, the equivalent mindset means using instruments and wrappers available to you, such as EPF, NPS where appropriate, PPF for safety-oriented goals, and mutual fund SIPs for equity wealth creation. The account name changes by country. The discipline does not. Retirement wealth is usually built by regular investing, not sudden brilliance. A beginner also needs to know what not to do. Do not borrow money to invest in equities. Do not buy a stock because it is trending on social media. Do not confuse a low share price with a cheap valuation. On National T20 stock can be wildly expensive if earnings are weak, while a $2,000 stock can be attractive if cash flow and growth justify it. Do not hold 10 funds that all own the same large-cap names and call that diversification. Do not stop your SIP simply because markets fell. If your income is stable and your emergency fund is intact, market declines are the period when your fixed monthly amount buys more units. And do not expect every month to feel rewarding. Real compounding is often emotionally dull until the later years, when growth on past growth becomes visible. The first stage feels slow. The middle stage builds confidence. The later stage becomes powerful. That curve tests patience. Let's make this more concrete with 3 beginner profiles. First, a 25-year-old salaried employee with $8,000 a month available for investing after essentials and emergency savings. A practical setup could be $6,000 into a low-cost broad market index fund, an SIP, and $2,000 into a flexi cap or another diversified equity option, keeping the process simple. Second, a 32-year-old professional with irregular bonuses and moderate risk tolerance. That person might use $10,000 monthly SIPC into equity funds and then deploy bonus money by splitting it. Perhaps 50% into debt or liquid reserves for goals within 3 years and 50% into equity for goals beyond 7 years. Third, a 40-year-old beginner with family responsibilities and fear of volatility. That investor may be better served by a balanced allocation, for example 60% equity and 40% debt, with the equity portion primarily in index funds and only a small optional direct stock sleeve. None of these are universal prescriptions. They are examples of matching behavior, horizon, and risk capacity. Suitability matters. There is another reality beginners should understand about the numbers in 2026. India's investing ecosystem is growing, but growth in accounts is not the same as growth in informed participation. The NSE's 13 crore unique investor milestone and the mutual fund industry's already 81.58 lakh crore AUM are signs of scale. Yet SEBI's awareness to action gap tells us many households still know about products without using them confidently. Only 9.5% invest in securities market products, even though 63% are aware of at least one. That difference is enormous. It means the next wave of wealth creation will likely depend less on app downloads and more on education, trust, and process. It also means beginners have an advantage if they start correctly now. When a field is crowded with opinions but still underpenetrated in disciplined behavior, simple evidence-based habits can stand out dramatically over a decade. Clarity compounds. So what should you do in your first 30 days? Here is a practical roadmap. In week 1, calculate monthly essential expenses and build your emergency fund target number. In week 2, clear or aggressively plan down any high-interest debt and decide your monthly investing amount. In week 3, complete KYC, choose a low-cost investment platform, and open the accounts you actually need. Mutual fund access for index sit-ups, and a DMAT only if you truly plan to use ETFs or direct shares. In week 4, start 1 sit-up in a broad index fund, not 5. 1. If you want to learn direct stocks, add only 1 or 2 companies after doing basic research and cap that exposure tightly. Then automate the next contribution immediately. Beginners often overemphasize the first investment and underemphasize the second, third, and 100th. The repeated action matters more than the opening ceremony. Before we close, I want to tackle the emotional side one last time. Beginners often think successful investors have better predictions. In reality, they usually have better rules. They know what percentage of income they invest. They know their asset allocation. They know how they respond when markets fall 15%. They know when they will review and when they will ignore noise. Most importantly, they understand that the stock market is not a salary substitute or a quick-fix machine. It is a long-duration ownership vehicle. If you treat it like a casino, it will punish you. If you treat it like a disciplined savings and ownership system, it can reward you over many years. The market does not owe you speed. It rewards consistency. Here is the bottom line. If you are a beginner in India today, you do not need a genius-level strategy to start investing in the share market. You need a basic safety cushion, a monthly investment amount you can sustain, a low-cost diversified vehicle like an index fund or ETF for the core, a small and controlled direct stock allocation only if you want to learn, and a schedule that runs whether headlines are exciting or terrifying. The data already shows millions are entering the system through mutual funds and DMAT accounts. The harder challenge is staying active, informed, and disciplined after the account is opened. Be one of the investors who keeps going. That is where the wealth gets built. If this video helped you turn confusion into a concrete plan, subscribe to YieldWire for clear, data-driven investing education without hype. Then comment with your answer to this question. If you are starting today, would you choose direct stocks, an index fund, or an ETF first, and why? And save this video for the next time a market headline makes you feel either overconfident or afraid, because your process should be stronger than your mood. This video is for educational purposes only and is not financial advice.
Always consult a licensed financial advisor before investing.